Right, so my name, as Bianca's just said, is Carla Desai. Just to reiterate, please feel free to make this as an interactive a session as you would like. I'm very happy to take questions as we go through, so if you just post them on the chat, then hopefully Bianca will give me a nudge and I will pick them up. Yeah, I'm here to talk about sort of a little bit about our fund, but a little bit about the debt product or the venture debt product, when it might be useful for you, and also, you know, to have a little bit of understanding about what's going on in the market right now, and to look at some of the alternative options and how even our fund might be adapted to some uses going forward. So we'll talk through that as we go. Perhaps if I could just ask Bianca to share the next slide. Right. I think it's quite important that you know a little bit about the FSC group and who we are, and I'll tell you why. We spend a lot of time asking business owners, managers, lots of detail and lots of questions about them, and I think it's really important that all owners and fund operators do a little bit of due diligence on, you know, who their debt equity providers are. Who are they? What are their strategic objectives? And why are they in this business? So to give you a little bit of background on us, FSC actually started helping and supporting SMEs in 2002. And we are set up as a market gap finance provider. That is a term that will be a recurring theme through this presentation. The point of our fund is that we're there to provide sort of debt facilities to people that probably aren't going to get them from some of the traditional providers or the challenger banks. And if you can get funds from those people, then I would suggest, you know, that's definitely your first port of call. What we're effectively trying to do is get you to a position where you are able to achieve growth and perhaps access some of those more traditional lenders going forward. Okay, FSC Group actually started work or operations in the southeast of the country, and we've now spread so that we're all along the south. We're in the Midlands, we're in London now through the fund that I'm representing today. Okay, we're very, as a fund manager, our ethos has typically been dual purpose funds. So what does that mean? It means that we're looking to support financially viable businesses, yes, but we're also looking to try and create jobs and drive economic growth. And that's reflected by the fact that the number of our stakeholders are people like the ERDF, Funding London, EIB, British Business Bank. They're all sort of entities that want not only for us to improve the you know, the business itself, but also the economy that we are operating in. FSC also have quite a traditional approach. Each client has an assigned fund manager, and, you know, Paul will step in at some point and he'll talk to you about one of his cases in particular that he's been working with. But the idea is that we stay in touch with that person throughout the deal process and beyond. And I think, again, that's something that you need to find out sort of from any investor that or a lender that works with you. How does the system work? That's a little bit of due diligence on us. So if you've got any questions on the FSC group, shout out. Otherwise, we'll move to the next slide, please, Bianca. Okay, so pausing for breath. The specific fund that we are looking at here is the Greater London Investment Fund. This fund was launched in May last year, 2019, so we've been around about a year now, and it was launched by the Mayor, and it was specifically a fund to support growing SMEs in London. Okay, it was a £100 million fund in total. 55 million of that is a debt fund, and 45 million is managed by MMC Ventures, who we work with very closely, which is the equity fund. And as I said, it was set up to try and address the market gap. And we're not trying to compete with other lenders. So, you know, as I said, we will work alongside banks and challenger funds. We can lend alongside them as well. But it was to try and help businesses that, you know, maybe take a little bit longer to understand, and that are smaller in their scope. We have typically, focus on the forward growth prospects of a business. So we're not really looking at what's happened in the past, but we're looking at your plan and trying to work with you with your plan and with your story and what you're developing. I think, you know, just talking about this fund in particular, it was set up as a London fund, and the businesses that we are trying to support, therefore, will be located in one of the sort of 33 London boroughs, or they will be investing in one of the London 33 boroughs. And we focused on a number of priority sectors, which are outlined on the slide, so I won't sort of repeat them. And they track the Mayor's priority sectors. So, you know, there's two key eligible things: what sort of sector you in, and where's your geography. The one thing I'd say is most of our sectors cover most businesses. We probably won't do anything with reputational risk, or we don't really do shopfront retail. So there are specific things that we can't do that aren't within our fund parameters. And again, it's always worth finding out what is available to you, and how you can access. So in terms of how you access funds and what might be appropriate. Okay.
Sorry, Carla, on that note, we do have a question from Chris. He's asking, to what extent your investment decisions are linked with strategy of relevant LPs, for example, regional?
So, okay, our investment decision is handled by FSE Group. The credit process is internal by FSE Group. We have outlined and agreed key operating parameters. So, you know, for example, there are businesses that we can't back. We can't do, as I said, on shopfront retail really, or financial intermediation or terrorism businesses. That's policy matters that we have agreed with our stakeholders. But on a day-to-day basis, we don't refer to our stakeholders. Our credit committee process is internal. The fund has been allocated and we then operate within those guidelines. Chris, does that answer your question? Bianca?
I think it does. I think it takes a bit of time for Chris to say if that. If not, he can just have a follow-up questions, and don't worry, I'll keep an eye on it.
Sorry, apologies. I'm struggling to keep up with the technology, so just shout if I've missed anything.
Chris says yes, thank you, Carla.
Okay. Oh wow, I've now gone into the chat. There we go. Right. Technology is clearly not my skill. So this is how the fund has been set up and what we're trying to do. And what I've talked to you a little bit about is geography and sector. And perhaps I can just introduce Paul, and he can talk a little bit about the third key criteria that we have, which is what are the use, what do we expect these funds to be used for? So that, you know, specifically we look at the money that's raised and how that funding is going to be applied. Paul?
Morning. Bianca, can you move this slide on, please? Lovely. Right. Good morning. I'm Paul, one of the fund managers. Use of funds, and primarily we fund 4 core things. And the first one is new staff hires, provided they are in London. One of the key KPIs we have to report to the Mayor of London's office on every quarter is the number of new jobs which have been created in London. You know, the purpose of this fund is economic benefit for London. So, new staff hires, product development, we fund product development. The product development can happen elsewhere. So it can be happening in India, Poland, wherever. We accept that lower cost development happens away from our shores on some occasions. But therefore, if people are looking for staff hires, we would want staff hires in London, therefore, to be salespeople or customer service people if the development work is being funded away from the UK. Entering new markets, so we will fund entering new market costs. But to just give you an example, if you had a business which wanted to set up a distribution network in the US and they needed boots on the ground in the US, then we can't fund that part of it because it's not job creation within London. And exporting abroad, we will fund exporting abroad activity. And the other one, which is very popular with people, will be sales and marketing activity. So if you imagine you're an early stage SME, not yet at profitability, maybe you've had a seed round and you're now looking to work towards a Series A, what are you going to want to do? You're really going to want a big spend on sales and marketing. You're going to want to bring in salespeople to drive that top line. And that's very much what we fund. We don't fund steady state working capital. We don't fund refinancing. We don't fund M&A activity. This is all about pure growth and additional growth costs. Do you want to move the slide on, please, Bianca? What does the fund look like? So it's not the cheapest fund, because I'll come to interest rate, in that we are lending against projected future cash flows to pre-profit businesses. So there's quite an element of risk attached. And as it's a debt fund, we don't take any equity upside as well. So we have no share on the equity side on the upside of the businesses being successful. So terms of the fund, 100k to £1 million over 3 to 5 years. Arrangement fee 2.5% paid up front. Interest rate. This fund is not a state aid fund, and European rules state that state aid funds have to be below 10.94%, and therefore if it's not a state aid loan it has to be above that, and our interest spread is between base plus 11 and base plus 15%. The earlier the stage of the business, the higher the risk, therefore the higher that end of that range the pricing will sit. Security. We do take security. We take a debenture, which we will rank behind other debenture lenders. We take partial unsupported personal guarantees. So what do I mean by that? We would take a guarantee of between 50% and 20% of the debt, but we have no backing security behind that guarantee. So if you as the owner of the business were putting up a guarantee on a, let's say, £100,000 loan from Glyph, we would look for a £50,000 guarantee, but with no backing security, so no second charges over a property or anything like that. And we also look for an assignment of a key person life policy for the full term and full amount of debt, such that if the key person in the business gets run over by a bus and regretfully killed, we get repaid in full. Any directors' loans we expect to be postponed behind us, because our fund can't be seen to be used to refinance any debt, hence directors' loans being postponed behind us. Next slide, please.
Sorry, Paul, before we move to the next one, there's a question related to the job creation. And is there a minimum amount of hiring that needs to be done with the funding that they get?
We would expect some hire. I would expect at least one job.
Thank you.
We overall, the fund has targets with the Mayor's office, but on an individual case-by-case basis, we don't, but we do look to make sure there's been at least one job created.
Clearly, the market and the environment has changed. And we are a growth fund, and I think we're very conscious of the fact that a number of businesses are not really driving growth at the moment. They're looking to see what they can do to kind of maintain a steady state. With that in mind, we have, as fund managers, received accreditation to provide an element of CBILS. Now, it's very important that I sort of explain where this sits. We're not like the banks providing CBILS to their existing customers. We are still retaining our ethos of being market gap providers. So it's quite a small proportion. Our total fund size is 55 million. The accreditation that we have received is for 4.3 million of our funds. Okay. However, we think that this might be really helpful for some of our clients. Won't appeal to everybody, won't work for everybody, but it could be very useful for some of our clients. This is all relatively new. Documentation still being finalized in terms of how it will actually be delivered, but it will broadly follow the same route as our traditional growth loans. And we thought this would be a useful opportunity to talk through this adaptation, if you like, of the product that we have in place. Okay. We are still targeting innovative, high growth businesses. Hasn't changed. Same market, and I guess the key difference from the mainstream lenders is that we will still look at your cash flow projections in assessing viability. So if you go to if you can get a CBILS from your main banks or your main banking sources, then that would be the appropriate source of finance for you. If you can't access CBILS, and Why might that be? I guess it might be because of a lack of track record or a lack of security. Then, you know, yes, potentially it would be worth coming to us. Bounce back loans are also something that a number of our portfolio clients have taken and are appropriate, depending on what size you are and whether that is sufficient for your needs. To be clear, this facility it's not a double dip. You can't have a CBILS and a bounce back loan and access this fund. It's one or the other. Okay. So we are still looking for businesses with good growth prospects, but those prospects have probably temporarily been put on hold as they deal with the impacts of COVID-19. Okay. And maybe I can give you an idea the sort of uses that we're seeing. Well, I guess we're sort of saying this might be a business where you might have to make some staff redundant, but you'd prefer not to because they're doing something or an activity that actually is useful for your future growth prospects. It might be that you're trying to bring people back from furlough to restart. It might be that you want to continue with an element of product development. So the difference between the growth loan and this fund is we're not driving growth in the same way. It's not really job creation, but it might be bringing back people or saving jobs that might be important for this business to find a platform or an even keel such that it's in a good place to deliver growth going forward. We also think that this product might be provided on a standalone basis, but it might also be combined with our core growth loans. So you will get through perhaps the initial period with your with a CBILS type loan, and then you'll be in a position to take a growth loan thereafter. To be clear, the loan might be provided on a standalone basis or alongside the growth loan. Okay. We're still focusing on our priority sectors. We still have the same requirements. We're still looking for businesses that have got credible and viable business plans, but it's a slightly different use. And I guess that's the key distinction between our growth loans and these CBILS style loans. Availability is limited. It's driven by the sort of current government BBB website. It's available until the 30th of September at the moment. It may be extended or withdrawn depending on the BBB's requirements. Okay. That was quite a lot to absorb, but I'm probably going to move to the next slide because I continue to talk about it on the next slide. But again, please jump in if you have any questions. So what we'd say is before approaching for this type of loan, you should make use of all available schemes, grants, local council facilities, HMRC sort of deferral. We want to know that you have been actively trying to manage the COVID-19 impact yourselves. And you know, if you can get, as I said, if you can get this money from a bank, that is where we would direct you in the first instance, as we have limited availability. Okay. You still, as per the fund guidelines, we still need to only back SMEs. They're the only people that we will support in this sort of environment. And we would need you to self-certify that you have been impacted by COVID-19. Okay. The idea is, what is a viable borrowing proposal is the area that I think is the most difficult to define. And I'd say that the traditional lenders, as I've said in the past, would look to the historics, would look to the security and see what was available. We will look to the forward-looking prospects. So we're looking to see in your next 12, 18 months, what you have done about COVID-19, what actions you have left to take, what the provision of a loan might enable you to do, and then also what platform that leaves you with at the end of the period. Okay. There are some businesses, there are some exclusions. This is driven by sort of the government guidelines and the BBB guidelines. We can't fund businesses in difficulty. Now, this is a definition that is governed by sort of state aid rules and temporary state aid rules. But a business in difficulty is defined as one that, as at the 31st of December 2019, had got accumulated losses which were more than half of their share capital base. Okay. Or it is a business that has existed for less than 3 years. So if you meet either of those criteria, then we might be able to help. Okay. We just move you to the next slide, Bianca. So this is quite a lot to absorb, I guess, because it's a slightly different product with slightly different uses to the growth loan. And so I've just sort of set out here how we see the key terms of this sort of CBILS type loan. We are lending between £100,000 and £250,000. The £250,000 cap really reflects the fact that it's only a 4.3 million allocation, and we want to make sure we can help as many businesses as possible. And also, given the size and the scope of the businesses that we're backing, we're hoping that that sort of amount will help see them through this sort of period. The term is assumed to be between 1 and 3 years. And you know, again, what we're hoping is that we see you through this period, and at the end of that period, either the traditional debt markets or the traditional equity markets have opened up again, and you can refinance at that stage, or maybe your cash flows have just come back and that enables you to refinance within that period of time. Okay. The interest rate is fixed at 9% per annum, and the arrangement fee is 1.5%. In line with the CBILS sort of press that you will have seen, the first year's interest and the arrangement fee will be covered by the UK government through business interruption payments. Okay. Repayments on this facility will be bespoke and agreed. I mean, typically we anticipate a capital repayment holiday probably between 6 to 12 months, and thereafter we will look at sort of a repayment profile, maybe bullets in there as well, to reflect, you know, that the fund is looking to help the businesses to stabilize and then drive growth. Okay. With security, the key difference from the core sort of growth loans, if you like, is we will still take security. This will be a debenture, but in line with the government terms, there will not be PGs for loans of this size. No personal guarantees. Any questions at this stage?
No, I think we can move through the next one. No questions at this point.
Okay. So if we just perhaps move, we'll move to the next slide in a second, but I guess the key thing here is the availability is quite restricted. It is still targeted at our client base, same sectors, same sort of businesses that are moving towards growth. But perhaps, you know, can't access the existing CBILS because they can't, you know, they haven't got their track record to be able to do so. Okay. I'm now going to kind of we're going to move to a more generic section. So one of the things that I think Bianca asked us to cover is, well, why would we choose term debt finance? And I think, Paul, you were going to pick up on that?
Yeah, happy to. I think that in the markets, if we go to pre-COVID, early stage businesses would look primarily to equity to get their fundraising. And I think one of the issues with equity, though, is, yeah, there's clearly cost attached to equity, because there's the cost of actually getting the round done and closed. And then there's that unknown cost about what's the payment, you know, what have you given away, and what's the business going to be worth in the future. And by giving away equity, you know, what has that price been to you? So for debt, early stage businesses tend to go for equity, but we're seeing right now, because of COVID, we're seeing a lot of the equity markets are drying up quite a bit. Investors are sat on their cash. They're probably looking to protect their existing investments in the businesses they have invested in, rather than look for new investments. And therefore, we're definitely seeing a move at the moment where early stage businesses, which have revenue but have not yet got to profitability, will now start to consider debt as part of an overall equity raise. So when should a business think about debt finance? Clearly, they need market traction. They have to have proven that the product has got traction in the market. So we're not looking at MVP stage, we're looking beyond that. We would normally say to a business, we would expect you to have in revenue at the moment the amount you want to borrow. And that's simply, you know, the debt has to be repaid, and therefore you're going to need an element of revenue to be able to afford to service the debt. We look for businesses with a pathway to break even, ideally in the next 12 months. We may push to 18 months, but once that journey gets longer than that to get to break even, we feel the risks there are probably really an equity risk as opposed to a debt risk. The ability to be able to service loan interest costs, again, another reason why we want to see revenue. Why would somebody consider debt rather than equity? Well, it's the benefit of not having the dilution of the shareholding. And I mentioned this earlier, that one of the things that we often see people use our debt fund for is they've had a seed round, they've got some equity which is funding their runway, they want to go to Series A, and therefore if they've already got revenue but they really want to scale that revenue up and they want to bring in new salespeople and sales and marketing spend, that is where our fund enables them to achieve fast growth, to therefore boost the valuation, which they'll then get at a Series A. Okay, next slide. What are we looking for? We look for a experienced management team. We really like to see, if some of the management team have had exits in the past, we definitely want to see they've got experience of scaling up SMEs. We look for an experienced or a supportive investor base. So if people have followed on at seed rounds, that we like that. We want to see a pitch deck with a clear explanation of what the business product is, what the service is, what the problem is they're solving. We want them to be revenue generating. We've already covered that a few times. And we want to be able to understand the sales ramp up and the assumptions that sit behind it. Most of the businesses we look at are going to have a real hockey stick upturn on sales, trebling, quadrupling revenues over 1-2 years. And it's understanding why the business thinks that's achievable and what evidence they can produce, which gives confidence that those assumptions are accurate. We want to see a finance model which is over 3 years projected out month on month, P&L, cash flow, balance sheet. And we need a detailed breakdown of how the funds are going to be used. So, case recently, I'm doing a couple of cases I'm writing up at the minute, and we're seeing, it's how many jobs and what are those jobs and when are they coming on board? What's the sales and marketing spend going to be spent on and have that broken down? What's the product development spend being spent on and what benefits will that give? And when are those jobs coming on board and are those jobs in London? So next slide, process. Our process takes 6 to 8 weeks. I would probably go 8 to 10 in the current environment. But initially we get an expression of interest form in for a prospect, so we can just check that core eligibility of geography, sector and purpose. Then we will have a detailed conversation with the business around what the next steps are, which will be full application form, full finance model, 6 months bank statements, which enable us to write up a very lengthy 20-page credit paper, which does, and we do a lot of due diligence internally as we write that credit paper, with a lot of toing and froing and conversations with the directors of the business, so we really understand how the business operates. We present to a credit committee, 3 voters on the credit committee, 2 are external to the FSC group, and we have to get all 3 on board. If there's a point where we're not going to get the 3 voters to accept the deal as presented, if I just dropped out.
You're back, Paul.
I'm back, right. So I'm talking about the credit committee. If the voters don't all go for the deal, we do have a conversation around the table about what would need to be reshaped to get them confident and comfortable in supporting a proposition. So we do come out with what deal we will structure. Then we issue a facility letter, then we issue the security, then we draw the debt down. So that whole process takes 6 to 8 weeks there. I think at the minute it's taking about 8 to 10 on average. Okay.
What Paul, just jumping in there, the one thing I would say is that, the lengthening time for the credit approvals is actually been driven a lot by the businesses that we're supporting, because they've had to rework their plans in light of what's happened. Though we will look at potentially trying to streamline this process for this sort of CBILS backed element, and that will be quicker because we are very aware of the fact that the deadline is for the 30th of September. Just so you know, as I understand this, how the scheme works for that product, so long as you've got a facility letter signed and approved, then drawdown can happen up to 6 months after. But you have to have that approval done by the 31st and the facility letter signed and committed by the end of September. The only other thing I'd say is, look, to give you an idea, we've been established for a year, 31 businesses have successfully been through that credit committee process. It is a well-rehearsed path now, and committee are aware of the dual different types of loans that we now might be putting through this system, and are geared up for it. Okay. Sorry, there, Paul, but do you want to move on quickly, Bianca? I'm conscious of time, so I'll skip through the next 3 slides quite quickly. Just so you are aware, you know, FSE approach, as I've said, is quite a traditional approach. We do try and build up a partnership approach. The fund manager that you work with will stay with you after the deal is done, will collect monthly management accounts with you, will discuss them with you. The processes are robust, but they are well trodden, so people understand the route. The fund managers that work on the team are very experienced now at understanding what credit committee will want, so they will try and guide you through that process and make sure we've got all the right information before we even get to that credit committee stage. Bianca, can I just get you to move on, skip through the next 2 slides quite quickly. This one is our marketing slide. Sorry, the one before that was our marketing slide. It tells you a little bit about what our customers have said to you. And it, sorry, Bianca, and it talks about sort of some of the reactions that people have had and how they quite like that collaborative approach. I always think it's quite useful. The best way to advertise the fund and to tell you what we're doing is to talk to you through quickly some of the transactions that we have done. And Validus is one of those. Validus supports providers of financial services. So it's a SaaS technology platform which allows banks and accountants to effectively automate the reporting and analysis of business financials provided by their customers. But importantly, so what would they use our funds for? Well, the funding that we provided will allow them to hire new staff. And I think someone asked how many typically. Well, for this company, I think it's about 12 new staff that they were planning to put in place. And it also allows them to further develop their product. They've got a proven product, but there's additional things that they would like to do, and the funding will help with that. Paul touched on what do we look for, and management experience is key. And I think, you know, one of the things to draw out on Validus is, and the management team previously worked together at Experian, so we understood, they understand that, you know, their market they understand very well, and we were, you know, that provided lenders and I suspect investors with a lot of comfort. If we move to the next slide, that's PowerVault, and Paul did that, so I'm going to let.
Yeah, interesting deal, this one. This business makes big storage batteries, which you have in house. They're sort of the size of a tumble dryer, which enable you to store solar energy if you've got panels, or linked to a smart meter. You can take energy off the grid when it's low price and then release it back into your home when it would normally be a higher price, so to reduce your overall costs. Interesting business. It's low carbon environmental, so it ticks one of the key 7 strategic sectors. The deal we've split into 2 tranches, so it's primarily for new staff hires. So what we've said is, actually, let's split that loan into 2 halves. Have what the first tranche, which has been drawn down, that enables you to recruit the staff. We've got a 6-month capital repayment holiday on it. And then in 6 months' time, they will draw down the second half of the loan and therefore save on interest costs in that 6-month period. What we liked about the business was it had good market traction, so it had over £1 million of revenues, a very strong, experienced board with quite a few members with exits under their belt, so really like that. And we believe this is a sector which will really take off in the future. And it links in with a lot of government direction around energy savings and, you know, sort of the overall environment and the direction of travel that the government policies are going. You know, in future, houses will only be built to be powered by electricity, not by gas, and therefore this type of functionality could be very beneficial in that environment. Okay, Carla, over to you.
Okay, sorry. So the last case I want to talk about quickly is Jungle Creation. Last but not least, this is a digital marketing business, and they create videos for social media, so Facebook or Snapchat, for example, with a focus on food, craft, and DIY. And you know, one of the key positives for a business like this is actually they don't see a huge adverse impact from COVID-19. Their target market are in lockdown and therefore are using social apps more. So, you know, all the businesses that we see are at different stages, and therefore we're conscious. I guess the point I'm trying to make to potential, you know, borrowers are that they might be suitable for growth still at this stage, or they might need to look at the sort of CBILS type product. So it's just to flag the differences there. Again, they've got sort of strong digital brands, they've got a very strong management team, and they've got investor support, and they're some of the key criteria that we look for. Bianca, if you just flick to the next slide. The reason I put this slide up, it's tombstones of the number of the deals that we've done, but the reason I put this up, if you look at the top line, all of those were funded post-lockdown. And I think that's a really strong message to end on, because I guess what we're saying is we are still open and we are still doing deals through this time. It's just making sure we've got the right message and we're backing the right type of businesses that have done their homework in terms of how they've mitigated the impact of COVID-19. Open to questions, and to you, Bianca.
Thank you so much.
Actually, I've just seen Chris's.
Insightful. Yeah, no, that was really good. That was loads of information. We do have a question again from Chris, who says that given the risk profile and interest costs, should I be thinking of you as a type of MES provider?
And I think that's a very fair question, and I think that's probably quite valid. You know, we are sort of at those sort of rates because of the risk profile of the businesses we're backing. Typically, they're not profitable today, but they're moving towards profitability. So yes, you could think of us as a MES provider, because we can also be subordinated behind certain debt facilities. So there are a lot of similarities. I think, you know, the difference is we do have quite high prepayment penalties for the first 2 years, but we, you know, in the third year that drops quite significantly, but also we don't take any warrants, so there is really no equity dilution. So yes, what we're trying to do, I guess, is match the reward to the risk, and mezzanine might be one way you would see it. And I guess the key distinction to that would be the CBILS type product, which, you know, actually is not sort of mezzanine in any form really, because it's cheaper with no real prepayment penalties.
Thank you very much, Carla. And I think, not sure if you've included that in the next slide, but how can people get in touch with you and Paul?
Yeah, sorry, the contact details are on the next slide, well prompted. So, you know, please feel free to drop us an email. There isn't, you know, we do have a website, there is an application form on there, but if you have any questions or you're not sure whether a particular product works for you, I would say in the first instance, please just give us a call.
And I just want to let the audience know that there's going to be a follow-up email. And if anyone would like to be introduced and connected to either Carla or Paul, please do let me know. And I'm more than happy, as long as, and I'm sure both you and Paul would be happy to connect with anybody who comes in via this webinar. And Charlene in the chat has just included a link to the FSC Group Greater London investment funds. So please do go and check it out. And I think these are all the questions for today. So with this, I would like to thank Carla and Paul for delivering such an insightful session and for taking the time to share all the knowledge with us this morning. Thank you so much. Audience, thank you so much for joining. I do hope you found this session very useful. Wish you all a wonderful day. Again, thank you, Carla, Paul, and thank you to the audience. Goodbye.